So a lot of people typically have asked the parents of the bride and groom for their approval before proposing, but lately they've been going to someone else who they find has a more value perspective, and that is their accountant. Especially in these days when people are delaying and prolonging and bypassing marriage in light of the pandemic, they are turning to us to make these critical decisions. Let me tell you some examples of some of the things we've done for our clients. So one client, his income spiked to about $500,000 this year, and his girlfriend is a stay-at-home mom. She's raising their child together, and they live together. So what we found is that if they got married, we could put more income into those lower marginal rates because of the advantage you get when you are filing jointly as a married couple. And we would create roughly $35,000 of tax savings if they got married. The marriage, the tax savings could pretty much pay for the entire wedding itself if they wanted to do a big wedding ceremony. Another client, he partners with his girlfriend. They each own equal shares in a short-term rental, but only my client materially participates. If they get married, we can group their hours together and say that they both materially participate. And what does this mean for their taxes? Well, the client, we estimated that this rental will reduce his taxable income by roughly $98,000. Now, his girlfriend has an equal share in this activity. So if they partner together, we'll have an additional $98,000 reduction in taxable income for her now because now we get to say that she materially participated when we get to file that married joint return. So we're going to create, in this instance, being their tax rates, an additional maybe $30,000, $30 to $40,000 of tax savings for this client at the federal and state level. Another interesting conversation we had with a client is he is moving out of his home, his primary residence, and his girlfriend, who he lives with and also raises their child, is taking an interest in his short-term rentals. So my idea was that if you're not going to get married, here's what we can do to create some opportunities. You could sell your primary residence to your girlfriend. Because you live there for more than 2 years, it gets stepped up to fair market value. So what's going to happen now is you get some cash that comes in that you can use to reinvest in other endeavors. Your girlfriend buys it at the fair market value, so you get a higher basis. And then because we have a higher basis, we access more depreciation. And now because it's a new property and you did not live in it, because the girlfriend never had it as her primary residence, it will qualify for bonus depreciation when we run the cost segregation study. We we predict that will also create another maybe 30 to $40,000 of tax savings by shifting the property to your girlfriend if you're not married and taking advantage of that Section 121 exclusion on the gain of that transaction, combining that with cost segregation, bonus depreciation, and material participation of the short-term rental. If we can accomplish all those things in the year of either 2022 or 2021. So these are just some interesting conversations we've been having, and maybe you'll be having soon as the year closes and people are doing some year-end weddings, and maybe you'll be talking about this even more as Valentine's Day approaches. So one of the things you want to take away from this is if you're an accountant, make sure you're talking about these topics with your clients and the potential tax savings of either staying single or getting married on your returns, and also talk to your accountant on the tax implications of of getting married, also the timing of when you get married, and all sorts of opportunities we can plan for. Include your CPA in your marriage plans. Hope this helps for some of you guys. Enjoy the rest of your day.